typically what marks the bottom in the market is hugely negative sentiment and essentially capitulation, where investors sell because they don't believe that it will ever get better. I can't ever remember a time in the last 25 years where sentiment has been as negative as it is now, and is globally, universally negative, where people all over the place don't feel like it'll get any better. But what'll be fascinating to see is if December 5th of 2008 in fact marked the bottom, or was symptomatic of the bottom of the market in this particular part of the cycle, because on that day we had unemployment releases in both Canada and the US, and some very negative economic news in Europe earlier in the day. Markets reacted by selling off initially after the employment releases in Canada and the States, but finished the day fairly strongly higher on the day, and that carried over into the subsequent week as well. The other thing to note from a timing perspective is that in the last couple of months, stocks and bonds have been sold, and sold very aggressively, but partially, I think, only because they're very liquid, and they're actually instruments that investors and pension funds and hedge funds alike can sell to raise cash when faced with a margin call, or with the need to de-lever and shore up their balance sheets. Our sense is that that's taken stocks to levels that are particularly attractive, and is a signal of the capitulation that has been seen in the market, where selling really has taken place without any regard to the underlying intrinsic value of the stocks. It's simply been taken over because they're liquid and because they can be sold. Investors need to be very cognizant still of the fact that the current disruption in financial markets is reasonably unprecedented, at least in terms of recent memory. So there's no real blueprint in terms of how it's going to play out. And anybody that tells you that we're at the market bottom definitively, or that anything is going to unfold in a certain way, is probably overstepping their bounds a little bit. We're fairly early into the job loss cycle in the States. We've had employment declines for the last 24, 25 months. That's not quite as much as typical in a recession. So if this recession turns out to be longer and deeper, then we have more pain to come in that regard. And it'll be fascinating to see what some of the disruptions in the auto industry, for example, lead to in terms of follow-on job situations or follow-on job cuts. Of course, everybody's concerned that the cycle of job losses will intensify, and that will further impact and reduce consumer spending, which of course leads to reduced business activity and a compression of profit margins. Obviously, none of that would be good from a business standpoint. But our feeling is that a lot of that is priced into the market at this point, and it would have to be a very severe recession, and maybe even approaching a depression, in order for current valuations to be fully justified. Given current market conditions, I think the salient point is that it really doesn't matter for investors if we're currently at a market bottom or not. The market's giving us an opportunity to buy fantastic companies that are going to be able to maintain their dividends and continue to generate free cash flow at yields that we haven't seen literally in decades. So while it would be lovely to think that we were buying at the bottom, it will probably be quite irrelevant when you look at how some of these companies will perform over time.